Hello and a belated Happy New Year. Welcome to the first investment review of 2014, taking a look backward at the events of January and adding a little bit of thought as to what the rest of the year may have in store for us. Once again, we face potentially a year of some uncertainty, and we think that this will continue on a worldwide basis, both politically and economically. We need to have a think about what the prognosis is for 2014. It won't be lost on anybody at all that equities have not had a good start to the year, with emerging markets leading the way down, and neither of the developed markets escaped unscathed, as our graph later on in this report demonstrates. Global activity strengthened during the second half of 2013, and despite the very recent downturn, activity overall is expected to improve further across the years 2014 and 2015, largely on account of the recovery in the more advanced economies. According to the IMF, the International Monetary Fund, global growth is now projected to be 3.7% for 2014, rising to 3.9% for 2015. But predictions are, after all, just predictions, and there are no guarantees. Therefore, as 2014 unfolds, it will remain to be seen what events will affect the markets during the coming year. GDP, which is Gross Domestic Product, is estimated to have increased by 1.9% in the UK last year, that being its best performance since 2007. UK manufacturers are reporting increasing demand for goods such as IT equipment, plant and machinery, suggesting that a long-awaited upturn in business investment is finally taking place. This suggests that the UK economic recovery is strengthening as companies gain confidence in the economic outlook and they start to expand in terms of fixed assets and employment. The reduced fear of the Eurozone breakup, improved prospects for economic growth in countries such as the US and Japan, and fewer concerns about the banking system are all factors contributing to the increased confidence that are reflected in the UK GDP figures. Interest rates are of a concern to all of us. Those who save are seeing no real return on money, particularly when we take into account the effect of inflation, and those who borrow are enjoying incredibly low rates and so very low payments on, for instance, domestic mortgages. And the rates are still at an all-time low, and the latest reports from the Monetary Policy Committee show that although the unemployment rate is now very close to the 7% threshold, where a rate rise could have been forthcoming, they are not intending to raise rates now in the immediate future for fear of damaging the stability of the recovery. In addition, we have also seen that there has been downward pressure on UK inflation, which supports a continued low interest rate regime. In the emerging market countries, the start of the tapering of quantitative easing has been a flight of capital from these countries in search of better returns from the developed countries. The US has seen a fall in equities and a rally in treasuries. Globalization, where so many countries are interdependent in trade and finance, makes financial policy coordination more necessary than ever. This graph compares the journey of emerging and world markets over the past 6 months, and it demonstrates clearly the negative performance of the emerging markets since the tapering of US bond purchases began. Thinking now a little about oil and gas dependency. As the US is becoming more self-sufficient with its own energy resources, it is expected to become less reliant on imports of oil and gas from the Middle East. But a recent report issued by the International Energy Agency states that production of oil from shale formations in the US and worldwide are likely to provide only a temporary respite from reliance on the Middle East. This is one to watch in the coming years. And so, bringing the 2014 opening investment review to a close, in summary, with interest rates at an all-time low and likely to remain so for some time, when taking inflation into account, cash continues losing money in real terms. Investors, therefore, willing to accept some volatility in the value of their holdings over time may be rewarded with overall returns in excess of inflation if they hold assets in the stock markets. Key to the success of investing is the investor's understanding of the potential risk to capital in the short, the medium, and then the longer term. Holding your nerve and having the confidence to stay invested when markets are contrary is an important factor when considering your investment choices. Our process to assist you in determining the right portfolio for you should ensure that you are correctly placed to understand the inevitable ups and downs of the markets, how this may affect your money, and how ultimately you may then be rewarded. Thank you very much for listening. If you have any questions or any concerns, please feel free to contact us, and as usual, the end slide has all of our contact details.